Hello traders, Gary Wagner here, just about 10:10 in Honolulu, 4:10 in New York on Friday. Happy Aloha Friday, as we say on the islands, May 27th, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine it with trending markets, and we have a lot to report. Incredible markets this week, downside pressure, strong downside pressure in the precious metals markets. Equities markets running close to record highs, runaway US dollar to the upside, and a lot of that action today had to do with a statement made by Janet Yellen. We'll talk about that in a second, but first let's look at the current price of gold. Gold currently trading off about $10 on the day. We're looking at COMEX futures, 1210, down 1040 as I said. 1206.40 is the low on the day. 1223 on the high. As you know, we've had that marker at around 1208 in which we felt gold should trade down to. We've actually hit that target. On today's report, we'll talk about what we think gold will do next week. Let's take a look at our first gold chart. So traders, as you know, we have been sidelined and anticipating lower gold prices over the last couple of weeks. First chart I've pulled up is a candlestick chart, weekly format. Each candle represents a week, and in this way we can have a really strong idea of where the market opened and where the market closed on the week, and that's this single candle here. As you can see, the open to this candle comes in at roughly about call it 1250. The close, as we look at it right now, is going to be around 1211, 1210 in that area. So quite a dramatic decline on the week. The other thing is, if you recall from the last couple of weekend reports, and that's typically when I'll look at these weekly charts, primarily because the week is finished and I know we've got a fully formed candle, and that is that we had this three-river evening star, long green, doji star, and then a red candle. However, because of the size of the red candle when we compared it to the green, I didn't give it the kind of credibility or strength that maybe I should have. We certainly saw that on last week's show, because then we had a combination of not only this candle here, but another lower high and lower low, and a tremendous sell-off, as I said, breaking to a point in which we can find a potential first level of, call it, support in the market. To do that, I want to pull up a chart that we have been using over the last couple of weeks. This is a daily chart. On this daily chart, we have our fib retracement points as well as Elliott wave count. And the way that I am looking at it at this point, and we'll go ahead and pull up our big picture chart in a second, but of course, we have the culmination, the termination of that long protracted sell-off. Market comes, trades to a intraday low of about 1040, and from there the market took off. We had a series of rallies and a series of corrections, a dynamic rally, what we labeled as a 3. We had our compression triangle for our 4th, and that popped us up to our 5th. At this point, I believe that formed a subcount A. And that subcount A was then followed by a correction, because of course what we're looking at is on a B wave, and that's what all of this is part and parcel of. But on a B wave, we're going to look at a basic wave, the motive phase, so to speak, that's moving to the upside, and that's based on the fact that that A wave really witnessed gold from 1920 down to 1040, and now we're looking for it to move back up to about 1400, multi-year move, and in that we're going to see some corrections. These corrections, of course, and the counter waves, I should say, are running to the upside. That's just the way it's going to be. So that was our A. This completed our subcount B, and I believe this final clip up here, 213.06, completed the A here, which is a minor A right in here, subcount, and then our minor. Now from there, I believe we've gone into a minor B, and of this minor B, that minor B can take us anywhere on the lowest end of the spectrum that I would anticipate is about a 50% retracement, which is about 1176. But as you recall from the last couple of weeks, as this market's been drifting lower, my sense was that this market was probably headed to 1208. And that, of course, was based upon this one 38% resistance level at 1207. You can see that quite clearly. And you can also see how we dramatically have the low pretty much line up to the tick with that particular number. Now, the low today, 1206.40, 1207.50, so roughly within this area. What we need to do, of course, then is to take a serious look to see if we get the type of candlestick pattern beginning of next week. Of course, markets will start trading on Tuesday, but the beginning of next week that are indicating key reversal pivot points. That could be a engulfing bullish. It could be a piercing line. It could be a three-river morning star. There's a lot of key pivot patterns that are bullish patterns, a bullish harami. There's other ones also, but the key to what I'm talking about is once we identify a key reversal pattern and that V formation, meaning that this particular low held. So you've got the market tracking down, hitting these lows, and this is that V that I speak of. That's the V right here. But once we have identified, or if we identify, I should say, that V, that will tell us categorically that it's time to enter the market from the long side. Now, as I said in my opening statement, should this market break below this particular price point, meaning the 38% retracement, then I believe we could see a full-blown B wave here, which could take us to 50% of the rally, this being the rally here, but 50%, which would take it as low as 1176 before moving back up. So we're at a key level right now. Depending on whether or not we hold this area is going to determine our next move. And traders, to kind of put that all in perspective, I've pulled up our weekly chart in which we have our long count, the big picture as I call it. And on this chart, it's pretty evident that the dynamic rally that we had up to 1920, that concludes. This is that long dramatic spike down, which concluded not only a minor fifth and an intermediate fifth, but our major A wave. From there, my sense is that we went into this rally mode, and this rally mode, as we just saw, was a 5 count. That completed the A. Here's that B that we've just looked at, and then the C. That all completes this A right here. And as I said, now we're in this B wave. We're looking to see if it wants to hold up in this area right here. This is the first identified area that we would like to see. And if not, there's our 50% right at around 1166. So in terms of tying the last chart that we just looked at into the big picture, that's how the puzzle pieces all fit together. Silver also trading lower on the day, lower on the week, currently trading just above $16 per ounce at $16.18, low $16.14, just 4 cents off of the low, and the high on the day, $16.36. Now, in terms of a percentage drawdown on the week, this again is a weekly chart of silver. We certainly didn't get the same magnitude that we saw last week, of course, but we have drifted lower now for the 4th week in a row. Current levels of support that could enter the market that we're looking at, and these again are Fibonacci based as well as trend based. And when I say trend based, what I mean is when we're picking certain tops or bottoms in the market as key levels, if they line up with a fib level, such as this top here and this 50% retracement here, that gives it the weight or the credence that we need to believe that that is an area that should hold some sort of weight. So right now, 1606, so call it $16 per ounce. That's the next level that I would look at for potential support in silver, in the same way that we're looking for potential support in gold at about 1208. Below that is 1550, and that is a 38% retracement. Now, traders, it's a 38% retracement from $21 down to below 1368. So it's quite a large data set, so to speak. But those are the levels that we're looking for in silver. Of course, one of the consequences of a interest rate hike or potential interest rate hike in June, which seems more likely than ever, is going to be a strong U.S. dollar. We have seen that throughout the entire week, and we're certainly seeing that on the close of today's trading as we go into an extended 3-day weekend for Memorial Day. A dollar up over 0.5%, 0.63, 95.76. That's the current print that we're looking at, and that is a substantial gain not only on the day, but as you'll see in our first chart, on the week. So traders, no doubt, ever since the market hit 100 on the dollar index, or I should say the last time that it hit 100 on the dollar index, we had a little dip and a secondary try which contained a lower high, but really since this point the market has been in a free fall. And interestingly enough, when the market broke below 93, actually to an intraday low of 92.09 here, and it broke roughly just below that 92 on the index, on that particular day, there was a flurry of buys that came into the market, very, very supportive. Over the last 4 weeks, we have seen the dollar really become a runaway freight train, moving up substantially and closing now above a 23% retracement level, which sits at 95.34. Markets closing at 95.75. And so that tells me that we could and should see a little bit more dollar strength at the beginning of next week. Now, as I spoke about, Janet Yellen made remarks during an interview today at Harvard's Radcliffe Institute for Advanced Study, and I'm quoting her. It's appropriate, and I've said this in the past, I think for the Fed to gradually and cautiously increase our overnight interest rate over time, and probably in the coming months, such a move would be appropriate. And that kind of statement kind of puts another nail into the possibility of a rate hike. At this point, we have pretty much factored that into the market. If we do not get a rate hike in June, of course, all of that premium that was eroded in gold would come back. All of the strength in the dollar would erode. And so what we want to see is how that all plays out. But all things being equal, this dollar strength could and should, in fact, continue next week. One of the other reasons that I feel so strongly at this point that we will see a rate hike from the Fed in June is the fact that when they put out feelers, meaning when minutes were released on the last FOMC meeting, we didn't see the U.S. equities markets react in a negative way. We had an incredible housing start report coming out just following that. That began this rally that we saw this week. Dow Jones closing up modestly today, but strongly on the week. We'll take a look at that, but 17,873. So we're just shy of that 18,000 marker. Same thing with the Standard & Poor's when we look at that. 2097. This, of course, is the E-mini, up about 8 points on the day. And, of course, we're getting much closer to that elusive 2100 in the Standard & Poor's 500. We do have a trade setup in the S&P that we're looking to execute next week. And, of course, that's what we want to talk about at this point. So traders, of all the markets that we have been following, I think that one of the most grandiose moves that we're going to see over the next couple of weeks could be in U.S. equities. We have had U.S. equities really on a rampage over this last week, and that's after coming off of a correction in which the market flirted with roughly that 2100, that elusive area, and those historical tops. We can see these tops right here and also right here. We exceeded that. You can see that right here. And the way that I'm looking at the market is we had the conclusion of a major retracement in the market that really culminated or terminated, I should say, call it mid-February, and that was a C wave. From there, we went into, I believe, a bullish count, and the bullish count was 1, 2, 3, 4, and 5. And that fifth wave took us, as I said, up to around 2100. At that point, I believe we went into a correction, and I'm counting an A, a B, and a conclusion with this C wave here. And of course, this is the rally that we saw really occur this week. A couple of things when we look at this that are quite revealing. And one of the most revealing pieces of technical data is the fact that earlier this week, we saw the market break back above its 50-day moving average first. Secondly, we had this golden cross that occurred mid-April. That is when the short-term moving average, this is our 50-day, our 200-day in blue, crosses over the longer term. However, at that point where this cross actually took place, you can see that the market was still fully immersed in the correction, and it took quite some time for it to really find a potential bottom in the market. That being said, I believe that we could certainly be moving back into a 5 count or a bullish stage. And what I mean by that is that if we in fact have completed, let's move this over, but in fact, if we have completed this C wave and this correction here, then we should again go into some sort of a 5 count. 1, 2, 3, 4, and 5. And my sense right now is that over the next couple of months, if in fact this model holds true and is accurate in forecasting where we're going to go in U.S. equities, we certainly could see this market not only flirt with these historical highs, but absolutely take them out and move to new record highs in U.S. equities. And that's a play we certainly want to be involved in for those that are following us in trending markets. That's the setup, and we are looking to go long the Standard & Poor's 500 early to mid next week. Absolutely no doubt. This week has been filled with a lot of market movement indicating some defined trends that we have identified in the markets over the last couple of weeks. It is truly our belief that we could see U.S. equities run and flirt with record and historical highs over the next couple of weeks. I also believe at this point that we could in fact see a new record high in U.S. equities vis-a-vis the Dow Jones Industrial Average and the Standard & Poor's 500. Of course, first we have to break above those existing record highs before we go for a new one. But traders, I think that that is absolutely in the cards. As far as gold goes, we were looking for gold to trade to roughly 1208. We've hit that mark. What we need to look for beginning of the week are key reversal pivot point patterns, primarily in candlesticks that match up with valid fib retracements, which of course we are seeing with that 1208 number. That is where that number comes from. And to see now some sort of key V reversal in the market, and that would indicate a long initiation. In other words, that we would go long this market. Of course, all bets are off if we break and close below 1208. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Tuesday for another daily report. Bye-bye.